Swing Trading. Chapter 2. Essential Market Mechanics. Price does not usually move in a straight line for very long. It tends to advance, pause, weaken, and stabilize in recurring phases, and that repeating behavior gives the market a kind of structure. For a swing trader, that structure matters because the same setup can mean very different things depending on where it appears in the cycle. A sideways market after a long decline can be constructive, while a sideways market after a long rally can be a warning. The goal is not to label every chart perfectly. The goal is to understand what kind of environment you are trading in so your entries, exits, and expectations make more sense. Those recurring movements are usually organized into 4 broad phases: accumulation, markup, distribution, and markdown. Accumulation is where selling pressure starts to fade and price begins to stabilize. Markup is the advancing phase, when demand becomes strong enough to push price upward in a trend. Distribution is the stalling phase, near the top, where upward progress becomes more difficult even though sentiment may still look optimistic. Markdown is the declining phase, when sellers take control and price trends lower. The exact length of each phase can vary, but the sequence is familiar because supply, demand, fear, greed, and profit-taking keep showing up in similar ways. Accumulation often begins after a meaningful decline, when the market has already gone through a lot of damage. At that point, sellers are still present, but they are no longer as aggressive as they were during the drop. Price starts moving sideways instead of continuing sharply lower, and volume often quiets down compared with the earlier sell-off. Sentiment usually remains negative, which is why accumulation can look unimpressive at first. Many traders are still focused on what just happened, not on what may be forming underneath the surface. For swing traders, this phase is often less about rushing into a position and more about watching for evidence that stability is real. Markup begins when demand clearly starts to outweigh supply. Instead of simply holding a base, price starts making higher highs and higher lows, which is one of the clearest signs that trend strength is emerging. Volume often improves during this phase because more participants are becoming willing to buy as price proves itself. This is usually where long-side swing opportunities become much more attractive. Even so, it helps to wait for confirmation, rather than assuming the first bounce from a low means a new uptrend has started. A breakout from a base, followed by continued strength, often gives a better quality entry than trying to guess the exact bottom. Distribution tends to appear after a strong advance, when the market still looks healthy on the surface but begins to lose momentum underneath. Price may move sideways near the highs, and volume can stay elevated because there is active trading between buyers still feeling bullish and earlier buyers beginning to take profits. One clue is that new highs become harder to sustain. The market may push above resistance briefly, then fade back into the range. That does not always mean an immediate collapse is coming, but it does mean the easy part of the move may be behind you. For swing traders, this is often the phase where protecting gains becomes more important than chasing fresh, long entries. Markdown starts when selling pressure becomes the dominant force and buyers stop supporting price the way they did before. The chart shifts from stalling near the highs to producing lower highs and lower lows. Fear and uncertainty usually rise quickly, especially early in the drop, and volume can surge as people rush to exit. This is one of the most dangerous phases for long-only swing traders because a stock that looks cheap can continue falling much farther than expected. Trying to catch the bottom too early often leads to repeated losses. In most cases, markdown is a phase to approach defensively until clear evidence of stabilization begins to appear. These cycles repeat because the forces behind them repeat. Markets are driven by human behavior, and human behavior changes less than people think. Fear leads to selling, optimism attracts buyers, profit-taking slows momentum, and shifting expectations keep supply and demand rebalancing. That is why similar chart structures appear again and again, even though the exact timing and shape are never identical. One cycle may last a few weeks, while another may stretch over several months. What stays useful is not the perfect pattern, but the familiar progression from stabilization to advance to stall to decline. For swing trading, cycle analysis helps you decide where the better odds may be. Accumulation is often a preparation phase where you build a watch list and look for signs that a base may be turning into something stronger. Early markup is usually the most favorable area for long entries because trend strength is starting to appear and reward to risk can still be attractive. Distribution is a warning zone where tightening stops or taking partial profits often makes more sense than adding fresh exposure. Markdown is usually the phase where the long side trader becomes defensive and selective. In other words, swing trading is not about sitting through every phase equally. It is about participating more aggressively when conditions are favorable and stepping back when they are not. To identify the current phase, start by zooming out far enough to see several months of price action. The first question is simple. Is price generally rising, falling, or moving sideways? If it is sideways, the more important question is what came before that range. A range after a long decline may suggest accumulation, while a range after an extended rally may suggest distribution. Volume and breakout behavior can help confirm the difference. A sideways range by itself is not enough because the same shape can carry very different meaning depending on context. Imagine a stock called Green Tech falling from $50 to $20. After that decline, it spends time moving between $18 and $22 on lighter volume, which suggests the selling pressure may be fading and accumulation may be forming. Then it breaks above 22 on stronger volume, giving a much stronger case that markup has begun. If the stock rallies toward 35 and starts stalling there, that shift from trend to sideways action points toward distribution. A later decline back toward 21 would fit the markdown phase. This example shows why context matters so much. Sideways action after a decline and sideways action after a rally may look similar, but they often mean very different things. There are a few mistakes that show up repeatedly when traders try to use cycle analysis. One is treating every sideways market as accumulation without asking whether that range came after a decline or after a rally. Another is ignoring volume, which often provides useful clues about participation and conviction. A common expensive error is buying too early during markdown just because price appears cheap, and many traders expect cycles to look clean and textbook perfect, when real charts are often messy and uneven. Cycle analysis works best as a flexible framework, not as a rigid script. The evidence should guide the label, not the other way around. The main value of market cycles is that they help organize price action into a practical decision-making framework. If you can recognize accumulation, markup, distribution, and markdown, you gain a better sense of when conditions are supportive and when they are not. Price, volume, and context work best when read together rather than isolation. You do not need perfect labels on every chart to benefit from this approach. What matters is improving timing, avoiding obvious low probability entries, and staying responsive as the evidence changes. That gives us a strong foundation for the next skill, which is reading the price action inside those phases more closely. Price action matters because it shows what the market is actually doing, directly from price itself. Instead of relying first on indicators, you begin by asking how buyers and sellers are behaving on the chart right now. For swing traders, that can improve timing because price often reveals shifts in control before a lagging tool does. A strong push higher, a weak close near the low, or a failed breakout all tell a story about pressure and participation. Price action is especially useful when you combine it with the market cycle context we just covered. Once you know the environment, the candles and bars help you judge whether buyers or sellers are taking control within that environment. A single candlestick summarizes one full period of trading, whether that period is an hour, a day, or a week. Every candle contains 4 key prices: the open, the high, the low, and the close. The open tells you where trading began for that period, and the close tells you where it ended. The high and low show the full range price traveled in between. That simple set of 4 prices carries a lot more information than it may seem at first glance. Once you understand those pieces, you can start reading not just where price went, but how the battle unfolded during the period. The body of the candle is the distance between the open and the close, and it gives you a quick sense of who had more control by the end of the period. If price closes above the open, buyers have the stronger finish. If it closes below the open, sellers finish stronger. The wicks show where price traveled during the period, but could not hold. A long upper wick tells you price moved higher and then met rejection, while a long lower wick tells you price moved lower and then found support. So a candle is not just an endpoint. It is a record of pressure, rejection, and control during that period. A bar chart tells the same story as a candlestick chart. just in a different visual format. The top of the bar is the high, the bottom is the low, the small tick on the left is the open, and the tick on the right is the close. So whether you use candles or bars, you are still reading the same four pieces of information. For example, if a bar trades much higher during the session but closes near the low, that is still a sign that sellers took control before the period ended. The shape may look different, but the meaning is the same. What matters is understanding the message in the open, high, low, and close. Before you rush to name a pattern, start by reading the structure of the candle itself. A long body with short wicks usually shows clear control from one side. A small body with long wicks often shows hesitation, conflict, or rejection in both directions. A close near the high suggests buyers had control into the finish, while a close near the low suggests sellers stayed in charge. This step is important because pattern names can become a distraction if you skip the underlying meaning. Structure comes first, and the label only matters if it accurately reflects what the candle is showing. There are a few common reversal patterns worth knowing, but they should be treated as clues rather than guarantees. A hammer has a small body with a long lower wick and can suggest that lower prices were rejected. A shooting star has a small body with a long upper wick and can warn that higher prices were rejected. An engulfing pattern uses two candles, where the second body fully covers the first and shows one side overpowering the other. A doji forms when the open and close are nearly the same, signaling indecision. These patterns can matter, but only when they appear in the right place and after the right kind of prior move. What a pattern suggests depends heavily on what came before it and where it appears on the chart. A hammer after a decline, especially near support, can show buyers starting to step in. A shooting star after a rally, especially near resistance, can hint that seller pressure is beginning to appear. A bullish engulfing pattern can show buyers overcoming sellers, but it means more after weakness than in the middle of a random range. A doji is even more limited because it shows indecision, not confirmation. So the pattern is only part of the message. The trend and location are what give that pattern meaning. A practical reading process helps keep you from reacting too quickly to one interesting candle. Start with the trend so you know whether the market is generally rising, falling, or ranging. Then read the single candle first before deciding whether a named pattern is actually present. After that, ask whether the pattern appears near an important area such as support or resistance. Finally, wait for the next candle to confirm the idea instead of trading the pattern in isolation. This routine may feel slower, but it usually leads to better trade judgment and fewer impulsive decisions. Suppose a stock has been falling for 5 straight days and then prints a hammer near a prior support level. That long lower wick tells you price moved lower during the session, but buyers pushed it back up before the close. By itself, that is only a possible sign of rejection. If the next day produces a strong bullish candle that closes well above the hammer, the case becomes much stronger that buyers are actually taking control. That follow-through is what turns an interesting candle into a more actionable setup. A swing trader might consider entry after that confirmation, with a stop placed below the hammer low in case the reversal idea fails. Most price action mistakes come from ignoring context or giving a candle more meaning than it deserves. A doji, for example, is not a full reversal signal by itself. Traders also get into trouble by ignoring the larger trend, trading patterns in poor chart locations, or overlooking wick length and close location. Two candles may look similar at first, but a strong close and a weak close can carry very different messages, and even high-quality patterns fail sometimes, because price action is probabilistic, not certain. That is why confirmation, location, and risk management remain essential. Price tells you which direction the market is moving, but volume helps tell you how much participation is behind that move. In simple terms, volume is the number of shares traded during a given period. When price moves with strong volume, it often suggests broader commitment from buyers or sellers. When price moves on weak volume, the move can be more fragile because fewer participants are involved. Volume does not predict the future by itself, and it should not be treated as a standalone signal. Its real value is as a confirmation tool that helps you judge whether price action looks stronger or weaker than it first appears. When price and volume move together, the trend usually has stronger support. In an uptrend, above average volume suggests that buyers are actively participating in the move, rather than merely letting price drift upward. In a downtrend, above average volume shows stronger selling pressure and broader agreement with the decline. More participation does not guarantee continuation, but it often makes the move more credible than price alone would. This is especially helpful for swing traders deciding whether a trend has enough energy to continue. Confirmation from volume adds weight to what price is already showing. Volume also helps by telling you when to be more cautious. If price keeps rising but volume steadily shrinks, the move may still continue, but confidence in that continuation should start to weaken. Fewer participants are supporting the advance, which can be a sign of hesitation. On the downside, a falling price move on light volume may suggest that selling pressure is not especially broad or urgent. That does not automatically mean a reversal is coming, but it can hint that momentum is fading. In these situations, you watch more carefully for slowing, stalling, or reversal signals, instead of assuming the move is as strong as it looks. High volume is not always a sign of healthy continuation. Near the end of an extended rally, a large volume surge with only a small additional price gain can suggest buyer exhaustion. Something similar can happen late in a steep decline, where heavy volume may reflect panic selling rather than the start of another strong leg down. The key warning sign is huge participation without much further price progress. That can mean the move is becoming climactic rather than sustainable. Context is what makes this useful. A random volume spike in the middle of a normal trend means far less than a spike appearing after an already extended move. Volume becomes especially important when price is trying to break out of a range or clear an important level. If a stock moves above resistance on strong volume, that breakout is generally more credible because more participants are accepting the new price area. Strong participation suggests the move has support behind it. By contrast, a weak volume breakout is more vulnerable to failure because fewer traders are actually backing the move. Those are the breakouts that often slip back into the range and trap late buyers. For a swing trader, checking volume during a breakout is one of the simplest ways to improve selectivity. A simple process makes volume easier to use consistently. Start by identifying the market condition first. Is the stock trending, ranging, or drifting sideways? Then match each price bar to its volume bar so you are reading them as one event rather than as separate pieces of information. After that, compare current volume with a recent average to decide whether participation is normal, stronger, or weaker than usual. Then read price and volume together. Finally, return to support, resistance, and trend context, because volume is most useful when it helps clarify the market structure rather than distract from it. A few common price-volume combinations can quickly sharpen trade judgment. If price is rising on above-average volume, that is usually a stronger confirmation of the move. If price is rising on below-average volume, the advance may be less reliable and more prone to fading. If price is falling on above-average volume, downside pressure is likely stronger and more broadly supported. If price is falling on below-average volume, selling may be losing force. These combinations are not final answers, but they are an efficient first pass before you study the rest of the chart more closely. Volume divergence happens when price pushes to a new extreme, but volume does not confirm with similar strength. For example, a stock may reach a new high on lower volume than the prior rally, suggesting the upward move has less conviction behind it. A new low on weaker volume can similarly hint that a decline is losing force. Divergence does not guarantee a reversal, and it often appears before any actual turn takes place. That is why location matters. It becomes more meaningful near support, resistance, or after an extended move where momentum was already vulnerable to fading. Consider a stock trading between 170 and 180 for 2 weeks. If it breaks above 180 and closes at 183 on 65 million shares, while the recent 10-day average is 43 million, that is a meaningful increase in participation and makes the breakout more believable. If price then rises to 188 2 days later, but volume drops to 30 million shares, the move is still positive, but the follow-through is not being supported the same way. That does not erase the breakout signal. It simply lowers confidence in the strength of the continued push. A swing trader might still stay with the trade, but with more caution than on the breakout day itself. In practice, weaker follow-through volume often calls for a practical response rather than a dramatic one. You might tighten a stop, take partial profits, or at least become more selective about adding to the position. One important rule is not to trade breakouts without checking volume in the first place. Another is not to assume that high volume always means continuation, because climactic spikes can mark exhaustion instead. And whatever baseline you use it consistently. So today's volume is being compared with something meaningful. Volume is most helpful when it shapes your trade decisions calmly and systematically, not when it is ignored or overinterpreted. Volatility describes how much and how quickly price is moving over time. A high volatility stock tends to make larger, faster swings, while a low volatility stock usually moves in smaller, steadier steps. That matters because volatility affects both opportunity and risk at the same time. More movement can create better profit potential, but it also increases the chance that price moves sharply against you. Just as important, volatility does not tell you direction. A stock can be highly volatile while rising, falling, or doing both in the same week. Swing traders pay attention to volatility because it directly shapes the trade plan. A stock that moves quietly can often be traded with tighter entry zones, smaller stops, and more modest targets. A stock that swings widely usually needs more room, which changes the stop placement and the size of the position. Profit targets should also reflect what the stock can realistically do, not what you would like it to do. And because wider movement increases risk per share, position size often has to shrink to keep total risk under control. In other words, the same chart setup can require a very different plan depending on the stock's current volatility. One practical way to measure volatility is average true range, or ATR. ATR estimates how much a stock has been moving per day on average, often over the last 14 trading days. A higher ATR suggests wider daily swings, while a lower ATR suggests tighter movement. ATR is useful because it gives you a recent snapshot of typical movement instead of a vague impression. Just remember that ATR measures movement, not direction. It tells you how much price tends to travel, not whether the next move is likely to be up or down. Before entering a trade, ATR can give you a quick read on what normal price movement looks like right now. If a stock is trading at $50 and its 14-day ATR is $2, that suggests roughly $2 of daily movement is typical in the recent environment. That does not mean tomorrow will be exactly a $2 day. It means your trade plan should respect the fact that the stock has recently been moving around that amount. This is useful because it helps keep your stop, target, and position size tied to actual behavior instead of guesswork. ATR is a planning input, not a forecast. Stops should be placed with volatility in mind, because a stop that is too tight can be hit by ordinary price noise. Many swing traders use an ATR multiple to give the trade enough room to work. If you enter at $50 and the ATR is $2, a stop 1.5 ATR below entry would sit at 47. A 2 ATR stop would sit at 46. Those wider distances are not about increasing risk carelessly. They are about matching the stop to the stock's normal movement so you are less likely to be forced out by routine swings. Profit targets should be just as realistic as stop placement. If you enter at $50 and ATR is $2, then a 3 ATR target would place your objective near 56, and a 4 ATR target near 58. Those numbers are grounded in how the stock has actually been moving, which is more useful than choosing an arbitrary dollar goal. Higher volatility stocks may support larger targets because they can travel farther in a normal swing. Lower volatility stocks often need smaller expectations. The basic idea is to let actual price behavior shape the target rather than forcing the target onto the chart. Volatility also affects position size because each share can move farther against you when swings are wider. If your risk per share is $2, then 100 shares exposes you to about $200 of risk. If volatility increases and your risk per share rises to $4, that same 100 shares now exposes you to about $400. To keep total risk near 200, you would need to cut the position to around 50 shares. This is one of the most important practical adjustments a trader can make. Wider stops usually mean smaller size if you want risk to stay consistent. Imagine buying TechCo at $40 when its 14-day ATR is $1.50. If you use a 2 ATR stop, that places the stop $3 below entry at 37, and 100 shares would risk about $300. Then earnings come out, volatility jumps, and ATR rises to $4. A 2 ATR stop is now $8 wide, which pushes the stop to 32. With 100 shares, the risk would jump to about $800. The trade may still be valid in principle, but the original size no longer fits the original risk plan. Volatility does not stay fixed after you enter a trade. News, earnings, analyst changes, and broad market shocks can all change price behavior quickly. That means part of trade management is rechecking whether the current volatility still fits your original plan. If risk expands too much, reducing size may be more sensible than pretending nothing has changed. You also need to ask whether the setup still fits the reason you entered in the first place. Any adjustment, though, should still respect your maximum risk instead of turning a manageable trade into an oversized one. Common volatility mistakes usually come from treating different stocks as if they behave the same way. Using the same fixed dollar stop on every stock ignores how differently those stocks actually move. Keeping share size unchanged while volatility rises can quietly double risk without the trader noticing. Oversized targets in quiet stocks create unrealistic expectations, and ignoring volatility shifts after major news can make an old plan obsolete. Another mistake is assuming high volatility automatically means a better opportunity. Sometimes it does, but sometimes it simply means more noise, more uncertainty, and more risk. The key idea is that volatility directly shapes the trade plan. Rising volatility usually means the trade needs more room, and more room often means a smaller position if you want to keep risk steady. Falling volatility can support tighter controls and more modest expectations. ATR gives you a practical routine for making those adjustments instead of relying on instinct alone. Read the stock's current movement, set stop distance accordingly, size the position to fit your risk limit, and choose targets that match realistic behavior. When the plan matches the stock's actual volatility, the trade becomes much more disciplined. A helpful way to organize market movement is to separate the bigger direction from the shorter counter moves inside it. The primary trend is the broader path of the market, while the secondary trend is a shorter move that runs against that broader path. In an overall uptrend, for example, the market may still have pullbacks that move down for several days or weeks. Those pullbacks are secondary trends. Many swing trades happen inside that relationship because traders often look for entries during the shorter move whilst disrespecting the larger direction. Trading with the primary trend generally aligns you with momentum instead of fighting it. To recognize the primary trend, start with the weekly chart and look back at least 6 months, often more. You are not trying to interpret every small fluctuation. You are trying to judge the dominant direction over a meaningful stretch of time. In an uptrend, major lows tend to rise over time. In a downtrend, major highs tend to fall over time. In a downtrend, major highs tend to fall over time. If neither structure is clear and price keeps rotating in a broad horizontal area, the market may be sideways rather than trending. This bigger view helps prevent short-term noise from distorting your judgment. A trend line can help visualize the primary trend, but the goal is not to draw the perfect angle. In an uptrend, you would generally connect major pullback lows, and in a downtrend, major rally highs. The exact steepness matters less than whether the structure keeps producing higher lows or lower highs over time. A shallow trend can still be valid if it persists consistently. Traders often make the mistake of forcing a line through every wiggle, which creates precision without clarity. It is better to estimate the slope of the bigger structure than to overfit the chart. Once the weekly trend is clear, the daily chart becomes useful for finding secondary trends. If the weekly chart is in an uptrend, you may look for a daily pullback that temporarily moves against that larger rise. If the weekly chart is in a downtrend, you may look for a daily rally that moves against the broader decline. These counter-trend moves often last from several days to a few weeks. For swing traders, they can create better entry zones because they offer a chance to enter with the larger trend after the shorter move begins to weaken. So the weekly chart gives direction, and the daily chart helps with timing. One of the most important questions is whether a sharp move is just a pullback or the start of a true reversal. A pullback is a temporary move against the primary trend, but the broader weekly structure remains intact. A reversal is different because the weekly structure itself begins to change. In an uptrend, that may mean lower highs and lower lows start appearing on the weekly chart. In a downtrend, it may mean higher highs and higher lows begin to form. A dramatic daily move can feel important, but the weekly chart is what tells you whether the larger structure has actually broken. Before entering with the primary trend, it helps to look for signs that the secondary trend may be ending. In a weekly uptrend, a daily pullback may first produce lower lows, but then those lows stop falling and higher daily lows begin to appear. That suggests selling pressure is starting to fade. In a weekly downtrend, a daily rally may first produce higher highs, but then those highs stop rising and lower daily highs begin to appear. That suggests buying pressure is weakening. None of these signs guarantee the primary trend will resume immediately, but they can improve the timing of an entry by showing that the counter trend move is losing force. Suppose a market rises from 4,000 to 4,800 over 8 months on the weekly chart. Along the way, each weekly pullback ends above the prior low, which tells you the larger uptrend remains intact. Then, on the daily chart, price drops from 4,800 to 4,500 in 2 weeks. If higher daily lows begin to appear around that area, that suggests the pullback may be stabilizing rather than turning into a full weekly reversal. An entry near 4520 would then be based on the idea that the secondary decline is ending inside a primary uptrend. If price later reaches 4,900, that outcome shows how the weekly chart provided direction and the daily chart improved timing. A practical entry process starts by defining the larger trend first. Use the weekly chart to classify the primary trend as up, down, or sideways. Then shift to the daily chart and wait for a counter trend move, such as a pullback in an uptrend or a rally in a downtrend. After that, look for evidence that the move is ending, such as improving structure, fading pressure, or supportive price action. The actual entry comes in the direction of the primary trend, not against it. This keeps the workflow simple: direction first, timing second. Most mistakes in trend analysis come from giving too much weight to short-term movement and too little to the bigger structure. A few weekdays inside a strong uptrend are not automatically a major reversal. Traders also get into trouble by fighting the primary trend too early, or by using intraday charts to define what should be a weekly idea. Another common mistake is entering before the pullback shows any signs of ending. It is also important not to confuse a clear counter-trend move with a sideways consolidation, because those are not the same kind of setup. The larger structure should stay in charge of the interpretation. The key takeaway is simple: primary trends provide direction and secondary trends provide timing. The weekly chart helps you define the broader environment, while the daily chart helps you spot shorter moves inside that environment. A sharp move on the daily chart should not automatically be treated as a major reversal. Instead, you look for structural evidence that the pullback or rally is ending and that the larger trend may be resuming. When those pieces line up, trade selection usually improves. You're not trying to predict every swing, only to align with the stronger side of the market. A single chart can give a very incomplete picture of what is really happening. A move that looks powerful on a short-term time frame may simply be a bounce inside a much larger downtrend. In the same way, a short-term drop may look dangerous even though the higher time frame still shows a healthy uptrend. Looking at more than one time frame helps you place that local move in proper context. This usually improves judgment because you are less likely to react to isolated signals. The goal is not to make the chart more complicated, but to make the decision more informed. The basic idea is to separate context from execution. The higher time frame shows the bigger picture, including trend, structure, and important support or resistance. The lower time frame helps refine the actual trade decisions, such as where to enter, where to place a stop, and whether the setup is improving or weakening. In practice, you read the trend first on the higher chart, then look for a setup on the lower chart that fits that context. Both charts are serving the same trade idea, just at different levels of detail. This keeps you from treating a local move as if it exists in isolation. There is no single correct pair of timeframes for everyone. What matters is that the two charts are different enough that each one adds meaningful information. If the pair is too similar, you often get repetition instead of insight. For a swing trader, daily and 4-hour charts can work well because one provides broader structure and the other provides more detailed timing. For a day trader, 1-hour and 15-minute charts may serve the same purpose. A useful rule of thumb is about 4 times separation, because that usually creates enough contrast for each time frame to contribute something distinct. A practical way to choose timeframes is to begin with the chart you actually use to place trades. That is your trading timeframe, the chart where your entries and exits will happen. Once you know that chart, add a higher timeframe that is at least about 4 times larger to give broader structure. So, if you trade on the 4-hour chart, the daily chart may be your higher timeframe. If you trade on the 15-minute chart, the 1-hour chart may serve that role. This keeps the process anchored in execution rather than theory. You trade on the smaller chart, but you interpret it with help from the larger one. Before you look for an entry, define the broader condition on the higher timeframe. Ask whether the market is in an uptrend, a downtrend, or a sideways range. In an uptrend, you should see higher highs and higher lows. In a downtrend, you should see lower highs and lower lows. In a sideways market, neither side has clear control over the larger structure. Doing this first helps keep lower timeframe signals in perspective, because it is much easier to avoid forcing a setup when you already know the bigger picture. Once the higher timeframe gives you a directional bias, the lower timeframe becomes the tool for timing. If the higher chart is in an uptrend, you generally prefer buy setups on the lower chart. If the higher chart is in a downtrend, you generally prefer sell setups. The lower chart helps you decide when the entry is becoming attractive, not what overall direction to trade. This distinction matters because many weak trades come from taking a clean-looking lower timeframe signal that fights the larger trend. Context first, trigger second is usually the stronger sequence. On the lower timeframe, you are looking for execution clues that fit the higher timeframe context. That might be a pullback with a trend, a breakout from a tight consolidation, a bullish or bearish candlestick pattern, or a retest of support or resistance. These details can improve entry precision, but they are also noisier than the higher chart. That means a good-looking signal on the lower time frame is not automatically meaningful by itself. It becomes more useful when it supports the larger structure you already identified. The lower chart is where you act, but the higher chart is what gives that action purpose. Imagine Sarah uses the daily chart for context and the 4-hour chart for execution. The daily chart shows a clear uptrend, so she begins with a bullish bias rather than treating every short-term drop as a reason to sell. On the 4-hour chart, price pulls back after a strong run, which could either be a simple pause or the start of something worse. Because the higher time frame remains strong, she interprets the decline first as a possible pullback rather than assuming reversal. If a bullish engulfing candle appears on the 4-hour chart, that becomes a lower time frame signal that aligns with the larger trend. In that case, the pattern is more meaningful because context and timing are working together. A good way to practice this skill is to turn it into a repeatable review process. Start by defining the trend on the daily chart. Then move to the 1-hour chart and ask whether the shorter-term action aligns with that larger direction or conflicts with it. Only look for an entry idea if the two charts support the same basic story. Whether you would trade or skip, record the decision in a journal. Over time, this helps you see whether higher time frame context is improving trade selection or helping you avoid weaker setups. Multiple time frame analysis works best when it is used consistently and with realistic expectations. One common mistake is trading directly against the higher time frame trend, just because the lower chart shows a tempting pattern. Another is using charts that are too similar, which adds clutter without adding insight. Traders also tend to mistake every pullback for a reversal, especially when the lower time frame looks dramatic. And sometimes strong context creates overconfidence, causing risk management to be ignored. The larger trend can improve the odds, but it never removes the need for discipline. The main takeaway is that multiple time frame analysis is a context tool. The higher chart helps you define direction, and the lower chart helps you refine timing. When the lower time frame signal aligns with the bigger structure, the trade idea is usually stronger than when the two are in conflict. That does not guarantee success, but it often improves trade selection and filters out weaker ideas. Used well, this approach helps you stop reacting to one chart in isolation. Instead, you learn to ask whether the smaller move actually makes sense inside the larger market story.